All right, here we go. And what is it that Carlos is going to teach today? Well, basically, I'm going to show you and teach you how to fine-tune any indicator. And I'm going to show you one indicator, but you're going to apply it. How to make an indicator work correctly based on what it is. Indicators are basically a tool that helps you, well, at least they're supposed to help you based on your decision making on the analysis that you make first. Once again, here's a problem that I see. A lot of people use indicators to tell them if they should get in or not before doing the analysis. And how many times have you find yourself saying, okay, here's a signal, I'm getting in, and the market going against you? The reason being is because you did your homework first. You have to sit down and analyze the market and identify price action first. And once you have kind of the main idea where that would be, then immediately you will use and can rely on indicators, which are lagging, most of them, to confirm the decisions that you make. Make sense? All right, so let's just go back in time a little bit and let's just try to make sense of the market here, anywhere in here. Go back randomly here. All right, so what we're going to do, I am going to install let's use a basic stochastic. All right, here we go. And this is a basic stochastic, 533, blah, blah, blah. We click OK. And here's a stochastic. Now, take a look what I'm talking about. Most of the indicators that they come from, from factory, as they say, they come coded as the average or the default set. It doesn't mean that you're going to rely on that. It doesn't mean that that's exactly what you're going to follow through, so on and so forth. Now, stochastic is one of the most one of the oldest indicators out there, and I want you to take a look at how the market, how the stochastic reacted. Oh my God, this is a good one. Can you tell here if the market is going up or down? No. Well, basically it gives you an overbought and oversold condition of any market in one direction. Meaning that if you would have relied to buy in here, the market went up, and you say, I'm going to get out in here, and I need to wait until the market hit the 20 level so I can get back in. And it's not until the top formation right here that it's giving you a buy again, just to see this upward movement. But what happened with this guy right here? What happened with this opportunity right here? Now, I left the moving averages that we use, and you can see how although the indicator over here suggested a sell setup or get out of the trade, like in this case right here, and let's say that it's doing another high, and you might say, let me put it like that. You might say, oh, they went too high right now, so they're probably going to go back down. So I'm going to short the market here. Boom, and you find yourself on a losing trade or not doing anything. Well, the truth of the matter is that now you have two indicators, right? Price action is indicating what? It's going higher highs and higher lows. So basically, we are on an uptrend. If we are on an uptrend, we should concentrate only on buy setups. Now, okay, I have the moving averages that they cross and they're separated, indicating that yes, we're doing an uptrend move perfectly. So that means that every time that the stochastics over here cross to the upper side, hopefully from at least from below 20, I would consider this a buy. How can I filter this buy setup if it never reached below 20, but the market indeed went up? Well, you're using the moving average as your warning signal from the false signals that this guy is going to be. You see how this works out? You already know where the tendency is going, right? Upward, up. So basically the market is coming down. They touch the moving averages, and I'm saying, okay, they should reach 20 and give me a buy setup because these guys are saying that they're going up. All right, price action, cross of the stochastics came about, and they cleared out back again the moving averages, meaning that I could went long any one of these two guys and hold this trade until it reached beyond 20, beyond 80. As you can see, beyond 80, and this small snippet of price level provide you about 23 points. Repeat the process over again. Check the moving averages, which usually are the strongest here, the one that I love the most, indicating new higher high, perfect, higher low. So a pullback towards the moving average will suggest that the pullback will be end or finish. No need of Fibonacci stuff in here. But I will get back into this trade as soon as I see the stochastic hitting 20 level or a cross up. Let's see. Okay, coming back down. All right, they just hit here anywhere. And I see the cross of the stochastics against, and I see that the market hit the bottom formation, so I could go long anywhere in here, place my stop a few points below this level, and moving averages are still separated. Let's see what the results would be. In this case, I probably would have got stopped out. Okay, so meaning these guys are reaching below 20 oversold conditions, so we lost a few points in here. And let's say the separation of the moving averages are still not, they hasn't still crossed to the downside. So let's see what's gonna happen. They should take this low in order for me to confirm the intended low downward move. Makes sense? Price action always rules. They recross back again, and now they're clearing out the moving averages again. So this was a false signals, but this is the second one, leaving behind another opportunity. That would be my entry until they reach 80. Oops, right there, and they reach 80, and in this case the market just provided about 15-20 points. All right, I'm just giving you a thought process here of how you can use the stochastics, in this case this indicator, and use the second one to filter out one with the other in order or in the trend confirmation of price action. So basically what I'm suggesting you here right off the bat is that the first rule will always be to focus yourself into identifying price action activity and learn price action first with no indicators whatsoever. Now let's take this one notch higher. All right, so let's just really make this professional. The way that I personally use it on all this year, obviously I've been paid a lot a few times to create system for other people. So they gave me their idea, they supply me with their indicators, and they tell me what they wanted to do. Basically what I try to find out is a correlation between price action activity and their indicators, between the window of opportunity that they're looking for. That window, it's actually a time base. It could be anywhere from 3 a.m. until 5 a.m. I got a client that says, Carlos, I'm using this indicator and I'm trading this market, and I only had about 3 hours to trade at, and I only can trade anywhere from in this case 4:30 in the morning to 7:30 in the morning. So I would like to see this if I can definitely create a trading strategy that could be applied with this indicator, because I loved it, period. So what I do is I sit down and then just go back in time, choose the right price. First of all, I try to find the between those two times, or the time frame that they're providing me, if indeed there is an opportunity, because there's only 15 points on average between those 3 hours. Don't even bother, right? So having said that, we need to choose first the right time frame, and then once I have the time frame and the price action selected and confirmed, that I can just identify, higher high, higher low, so on and so forth. Cool. I apply then the indicator, and this is how I'm going to be able to, let me just move it in here. I'm going to be able to identify and how can I better this indicator to my needs in terms of identifying that I should have, if I would only could have bought in here and sold in here, but this is giving me too many non-rubbish signals. So what I do is I start playing with the periods and the values of it, and start changing. Yes, it takes time, a lot of time, but it's the only way to make it work. So basically, just to make a long story short here, I usually try to go on these levels. I could go with 14, 5, 5, and take a look how different these guys will look right now. All right, check it out. You see how this looks? Now I have a very nice fluid movement from one side to the other, another like a very nice smooth area, and in this case they haven't crossed above 80. They're coming back down. Oh, they barely crossed 80. They haven't come down. but they barely crossed below 20 in this level. All right, so it's most likely a more clear tendency. Now here comes the 80 level, right, with the cross, indicating that this could potentially be the top formation of this trade or this movement in this case. Take a look how they reach below 20 completely, very nicely, not too much of a garbage in it, and suggesting a cross towards the upper side. All I need to see a clear cross above the moving averages here, and I consider this a buy. And there you go. That was it, and the buy came along, and let's see. Here's another cross to the downside that would suggest to obviously tight or stop or perhaps get out. But in this case, that would provide about 30 something to 40 something points in favor of the moving averages, obviously, because these are the trend indicators, so on and so forth. Now, this guy's a suggestion that the market is coming back down as they retest to the 20. They haven't reached beyond 80. So let's see what the price action says. The price action says that they made a new low, okay? And these guys are definitely not reaching below 20. Cross of the moving average are to the downside. Now I need to concentrate on sell setups. Do I short the market in this? Well, no. I'll have to let it go and wait for the next time that the market reach beyond 80. And that could have been, in this case, they failed to do it. All right. But once again, I explained to you earlier. Let me just explain to you again. I'm waiting for a pullback, and the pullback is here. But take a look where the pullback came. Oh, I'm about waiting for the 80. And that never happened, right? That never happened. You would say, okay, we lost the opportunity. No, remember what I talked to you about filtering one with the other. The market just reached the moving averages right here. So this is kind of a warning signal because that's as much as they were probably going to pull back. And I was waiting for the 80 cross over there. By the time that the cross of the actual moving average came about below 80, they cleared out the moving averages again in this area. So basically this is your short position and continuing yourself towards the downside. Now we can keep adding up, and I'm going to show you how price action actually rules. I hope so. I can do the typical triangle formation in these levels, right? It's the top of the triangle, and basically I will use this as the bottom formation. I'm just trying to find an intended move in the breakage. That's 52 from the breakage. That will put this trade on 52 pretty much around what, 87 even. And let's see if that actually plays out, and it looks like it did. Let's see, 87 even. Boom, right there. So you see how this plays out when you start adding one thing with the other one. And it's not a fancy stuff. It's basic stuff. This is a common indicator with another common indicator. But what would be the difference? What is the difference that has made this? The knowledge of identifying price action activity and understanding how price action behavior reacts on normal everyday moving averages. No fancy stuff. No complicated logarithm and stuff like that. Plain and simple price action. It's just a way that how you interpret their price movement in your favor by sitting down, study the market first, and then understanding and creating your own methodology. Identifying when this happened but this doesn't happen. Okay, this is what I'm going to be waiting for, period. And you create your own criteria and you create your own setups. All right, so I just wanted to show you with how different, in this case, the stochastics actually looked by just twitching a little bit of this area. I can extend this to 21, and let's see how different it looks. 21 looks even better, isn't it? Very nicely, very smoothly, so on and so forth. This is a buy setup. In the market make new lows while the stochastics are not making new lows. This is what you remember this? This is a divergence. Market making new lows while the stochastics are doing what? Higher. This is divergence. It means that as soon as they break beyond and cross the moving average toward the upper side, will validate the reversal point of price action. This is all old school stuff. All right, so basically, very plain and simple, price action. Take a look at this, price action. New lows, but this stochastic never made the new lows here in the 20. This is warning me of a potential bottom formation. Very old stuff. Are we going to be playing out the stochastic and buy here? No. I will wait until this high is actually taken and the clear cross and close beyond this moving average is validated. That would be there. Okay. Now we'll wait for a cross of the moving average to actually further validate our intentions. And usually they broke above this level. So now resistance turns into support. So red bar came about, and this is definitely the pullback area where I would love to see a clear close beyond that point. That would be, in personal opinion, the actual trade, and that would be the entry. And furthermore, the market just moved and gave us that opportunity. Got that? And once again, let me repeat the process again. Let me put it this way. We enter there. How far will they go? Well, I got two pivots in here. I got one, and I need the bottom formation here. I'm sorry. Bottom with this guy right there. And I have this, well, it looks like this is the 66 point from the breakage. And that's basically what I say, 66 point from this area. Okay, would be, all right, so it would be pretty close to 88.15, pretty far away though. So I will try to find another one, and the other one would be from this low to the most recent pivot high. That's 45. That's more like it. And pretty much the close would be, the entry would be 45 points will be where? All right, there, 87.98. So let's just mark that, 87.98. And just forward this very fast. Boom. By the tick once again, very nicely. So it looks like this triangle formation, or this width on the breakage, that would be the target for us. And take a look what the moving average did right at when they test that high. They're giving a cross, get out of this trade, and that will provide you with a clean cut, probably 27 to 44 something points. All right, so that's it now, guys. I hope you learned a lot. Go now, make it happen, make it work for you. There's no magic pills out there. There's no magic stuff. All that I teach, all that I do every single day is pure price action backed up by multiple confirmations before taking a decision. That's basically